Hi everyone, Marv Eisen here of Timeless Dollar, and today is Tuesday, April 5th. Let's talk about risk management and money management. And are they different? And if so, how do they differ? First, let's consider risk management. If you drive a car, you know you need auto insurance. And that auto insurance covers the cost of a collision or bodily injury. And that risk management is the risk of getting into an accident, the risk of damaging your car or someone else's property or car, or causing bodily injury to yourself or others. So in order to mitigate your risk, you purchase an automobile insurance policy. Now, that is how you manage risk of auto accidents. But what about the money management part? Well, the money management part is the amount of money that the policy covers you for. So while you can have a policy that covers you for, say, $100,000, it's not going to be enough if you get sued for, say, $300,000 or $500,000. You've managed your risk, but you haven't managed your money sufficiently. So let's relate that to trading. Risk management in terms of how you manage your trading in terms of managing your risk. Now, as I've said many times, trading is all about reducing risk. And if you can reduce risk to an absolute minimum, you should do pretty well at trading. So how do you manage risk as a trader? One of the ways you manage risk is, first of all, learn about trading so that you have an inkling of where the market is likely to trade, where prices are likely to go. And some of those things are things that I discuss every day, like the previous day's close, which I have here as this horizontal line. I have my calculated trading zone that I never fail to calculate every day, and this is based on Taylor's book method, a system that's been reliable for over 75 years. There are other ways to manage risk, knowing about support and resistance, knowing about intraday highs and lows, and also knowing about trade setups. So those are ways you manage risk. How do you manage your risk of the trade? Well, by knowledge and also by taking protective measures. What are some of those protective measures? Well, of course, stops are a very basic type of protective measure in managing risk. They manage the number of points that you are risking on a trade. Another way of managing risk, trade risk we're talking about, is with your rules. Your rules will also protect you if you have them locked inside, ready to act upon. So those are ways you manage trade risk. But what about being realistic with that risk? Well, you're looking at a chart of the E-mini, and this is a 3-minute chart, and this is today's April 5th price action. And there are 4 points between each horizontal line on this chart. As you can clearly see, each candle, each 3-minute candle, is about 5 or 6 points. So within 3 minutes, you can count on a candle or price moving 5 or 6 points one way or the other. So somebody who wants to manage their risk and thinks, aha, I'm going to manage my risk, I'm going to limit my risk to only 2 points. Well, that's simply not realistic. So in managing risk, you have to manage risk with a forethought of what the risk is likely to be. A 2-point risk on a day like this is simply not realistic. Now let's talk about money management. Money management, I've already spoken about money management in terms of a insurance policy with your car. Money management in terms of trading, well, there's a rule that's basically taught in all trading courses. I teach it in my course, and that is to risk no more than 1 to 2% of each trade. So if you have, let's say, $1,000 in your account, you don't want to risk more than, let's say, 2% of that. So what's 2% of $1,000? $20. You want to risk $20. $20 in a E-mini trade where points are each worth $50, you're only risking less than a half a point movement for your money. It's not a realistic method of money management to say that you're going to risk only 2% of your account. So you have to find the balance that's right for you based on your risk management. So money management is impacted by risk management. And if you're going to look at the one versus the other, first you really need to be able to manage your trading risk in order to intelligently manage your money. So the difference again between trade risk management and money management, one is the method that you use, and the other is the absolute monetary value that you are ascribing to the amount of money you're willing to lose. So I hope I've clarified that. Maybe I've muddied it a little bit, but hopefully you get an understanding that money management and risk management are actually two ends of the same spectrum. So having said that, I'm going to say thank you for watching my video. Trade safely and of course, use a lot of patience. Remember, tomorrow, April 6th is FOMC Day, and I'll speak about that in my video tomorrow morning. Thanks for watching again, and I'll see you in my next video. Marv Eisen for Timeless Dollar. And if you're looking for some education to improve your e-mini trading skills, check out my courses at timelessdollar.com. You can actually enroll in a free course that I provide, free course. And if you want to start your trading education the right way, what's better than free, right? Anyway, thanks again for watching. See you the next time.